In the last 90 days, fixed rates have gone up by almost an entire percent. And that's partially due to the 0.25% increase by the Bank of Canada, but also due to changing expectations with respect to the future of interest rates and inflation. And those changing expectations have many people choosing shorter term rates, which may not be the best choice, especially if they're being chosen solely with the purpose of trying to time the market and when rates may start to come down in the future. Because if we're being honest here, even though the Bank of Canada and the Fed in the US is predicting that in the next 3 years, interest rates are going to come down, well, their forecasts with respect to interest rates over the last couple of years have proven to be not even close to correct. So taking a short-term mortgage on the basis that the Bank of Canada or the Fed, or in general the market, is predicting that interest rates are going to come down sometime in the future is engaging in a game of speculation and is likely a game where the odds of winning are not on your side. And in today's video, I'm going to show you exactly what's happening with the bond market yields, which dictate the pricing of fixed rate mortgages. And at the end, I'm going to discuss what you should be doing if you're looking to get a mortgage in the next 6 to 12 months. And that includes not only those who are purchasing, but those who may have a mortgage coming up for renewal as well. But before I get into it, my name is Nolan Matthias, and if you want to thrive financially, this is the place for you. So do me a favor, hit that subscribe button and hit that like button so more people like you can see this video. Okay, so let's jump into this without delay today. I'm going to take you in and show you what's going on with the 5-year government bond. So as you can see today, the bond market yields are coming down. But if we go and we take a look at what's happening in the last 3 months, what you can see is that the 5-year Government of Canada bond yield has come up quite substantially since April. And if we take a look at the 6 months chart, you start to see just how big of an increase that was. And obviously this is partially to do with what's happening with the Fed and the Bank of Canada, both with respect to increased interest rates and changing language. But I want to show you the yield curve right now, because the yield curve is a visual depiction of what's happening with interest rates. And as you can see last year, which is the blue line, short-term rates and long-term rates were fairly consistent. But the black line, which is the current rates, shows that these shorter term rates, so the 2-year rate up to the 4-year rate, are still priced substantially higher than the 5-year rates. So in other words, what that means is that you can get a 5-year mortgage for cheaper than pretty much any other shorter term right now. And the tendency right now seems to be that people want to go and get a mortgage that is a shorter term with the expectation that they're going to be able to time the market and get a lower rate when that mortgage comes up for renewal. And I'm going to tell you right now that trying to time the market, well, it may be possible to do, is something that is just not a reality for most people. Because if it were, hey, we'd all be millionaires because we'd also be able to time things like the real estate market and the stock market, and we'd be able to make a pretty substantial amount of money pretty quickly. So make sure that you're steering clear of trying to time the market. Instead, pick a strategy that you can use for the next 5 to 25 years, whether that's choosing a fixed rate mortgage or a variable rate mortgage, and just stick to the plan. Now, the strategy that we use is we always choose the lowest rate that we can get at the time that we get the mortgage. So if that happens to be a 5-year fixed mortgage or a 3-year fixed mortgage or a variable rate mortgage, we always choose the lowest rate because we know statistically that if we choose the lowest rate at the time we get the mortgage, that is going to have the highest amount of benefit. And that is the exact same advice that I've been giving on this channel with respect to choosing a mortgage for the last 3 to 5 years. And it's the same advice that I gave in my 2012 book, The Mortgaged Millionaire, where I talked about choosing between a variable and a fixed. And by the way, that concept is not even one that I developed. It comes from a study by a gentleman named Mosh Milevsky, who did the research on fixed versus variable rates back in 2003. Now, obviously, in the last 12 to 18 months, there was an outlier situation where interest rates went up faster than anyone expected. And by the way, if anyone tells you that they expected interest rates to go up that fast, well, they may have been right, but probably for the wrong reasons. Now, let's get into mortgage rates as of today and show you exactly what they are. So, as of right now, interest rates are going up. This video was filmed on Friday, June 30th. By the time we get through the holiday and we're back to work on July 4th, interest rates pretty much across the board on 5-year fixed mortgages will be up substantially. In fact, they will be almost 1% higher than they were in April of this year. So as we always do, I'm going to talk about the full featured mortgages. These are the mortgages that come with low payout penalties. These are the mortgages that come with full prepayment privileges. They are basically the best mortgages that you can get in Canada at any given time. And no, these are not big bank mortgages because they have lower penalties. These are the mortgages that are sold by mortgage-specific lenders all they do is mortgages, and as a result, because they can't skate on their brand names like the big banks can, they actually have to have better products, which means they have similar prepayment privileges and almost always significantly lower payout penalties, which is going to be important if rates actually do go down. Because if you were to choose a 5-year fix today, because it's the lowest price mortgage, and interest rates do go down in 2 or 3 years, well, if you've got a low payout penalty, well, then you can assess whether it makes sense to pay that penalty and get a lower rate if it saves you money. And whoops, I had the 5-year variable screen up there. Switched it over now to the 5-year fixed, which is where we will start. So 5-year fixed full feature mortgages, as always, the lowest price is on the insured mortgages. The reason for this is because the lenders have that CMHC or that SAGEN or that Canada Guarantee Mortgage Insurance, which makes them super low risk for the lenders. So as a result, these are priced the lowest. So current rate is 5.34%. That is up by 0.4% from June 1st of this year. Now, getting into the most expensive mortgage that you can get in Canada, that's when you're putting 20% down. The reason for this is because it is where the lenders have the highest exposure. They no longer have insurance, and therefore this is the riskiest type of mortgage for a lender. It used to be back in the day that if you put 20% down, you got the best price. Well, that is no longer the case. You need to put significantly more down to start getting back into those insured rates. So you're looking now at 5.74% on that 20% down. Then at 25% down, you're looking at 5.74% again. Then at 30% down, you're looking at 5.64%. And at 35% down, you're looking at 5.34%. Now, as you can see, all of these rates have gone up recently. And it's important to note that you may still be able to get some of the lower rates from the last week, but it's going to largely depend on what individual lenders are doing and whether your timing is right. So if you act fast, there is a chance you may be able to get in at the previous lower rates, but only if you have a live deal. So in other words, you have a mortgage that's coming up for renewal, or you've already written an offer if you're purchasing a home. Then getting into 5-year variable rates, these are full featured. You'll notice that prime has gone up to 6.95% from 6.7 last month. This is because of that increase in interest rates from the Bank of Canada. These are all pretty much the same. So insured, you're looking at prime minus 0.9. Now that being said, that is now 6.05% instead of 5.8%. At 20% down, you're looking at prime minus 0.55. 25% down is the same. 30% down is prime minus 0.75. Greater than 35% down is prime minus 0.9. And for those uninsurable refinances over $1 million, greater than 25-year amortization mortgages, you're looking at prime minus 0.25%. Now, the next thing I'm going to show you is the discount mortgage rates. I'll explain a little bit here about what it means to get a discount mortgage rate, but if you want to know more details, the best place to get it is in my new book, Mortgage Secrets. You can go to mortgagesecrets.ca to get that, and all you have to do is pay the shipping and handling. So just like anything else in life, you get what you pay for. When you get a deal, it's usually because there's something stripped away or some feature missing from that product. So think about this from a car dealership perspective. You walk onto a lot, you look at two vehicles, they look exactly the same. Let's say they are BMW 3 Series, for example, but one is priced $20,000 higher than the other. They're the exact same year, they're brand new. Obviously, there's a difference between those two cars. Maybe it's some of the features or the luxuries that come with it. Maybe it's a service plan, who knows? But when you pay the lower price, you aren't getting as much as when you pay the higher price. And when it comes to mortgages, this is actually one of the most dangerous things that you can do is take a discount mortgage and not fully understand what comes along with it, especially these 5-year fixed mortgages. So for example, many of these have what's called a bona fide sale clause. What that means is that you cannot leave the lender until the end of the term unless you sell the property. So it means no refinancing unless you do it with the lender you're with. Hopefully you still qualify. And it means no switching to another lender for a lower rate if there's that opportunity available to you. So if interest rates do go down, like the Bank of Canada and the Federal Reserve is suggesting, well, if you've got one of these discount mortgages because you chased the lowest rate, well, you could find yourself in a situation where you cannot get a lower rate somewhere down the road. And what we always say is that any broker, any banker can save you 0.1 or 0.2%. The real money to be saved is on the big swings when interest rates change and they're able to save you tens of thousands of dollars by making changes. These types of mortgages, these discount mortgages, prevent us from being able to make those changes. Oh, and in addition to that, if you have a 5-year fixed mortgage with a big bank and interest rates go down, well, you're also stuck. And don't think that you can just blend and extend and that you'll get a better rate with that lender. The reality is that you're always going to have to pay that higher interest rate All a blend and extend is doing is averaging a longer term mortgage with the existing one that you have, but you're still paying those higher interest rates with your current lender. You're just committing to a longer period of time, and the lower rate for that longer period of time is being averaged into your existing mortgage. So the only way that you're able to make changes to an existing fixed rate mortgage and save a substantial amount of money is if you have a mortgage with a lender with low payout penalties. These are the ones like MCAP, First National, CMLS, and typically most broker channel lenders. Now I'll show you the 5-year variable mortgages. Again, I don't recommend these as discount mortgages because obviously if rates change and you need to lock in, you can't switch to a different lender. So you have to lock into whatever rate that lender is offering you. It means you lose all your flexibility and all your negotiating power, but I want to make sure you have full clarity and you can see them because when you Google interest rates on the internet, you're probably going to find these rates and they aren't always clear on what's different about these lower rates than the full featured ones that I mentioned at the beginning of the video. Now, that leads us into the conversation about what you should be doing if you're looking to get a mortgage in the next 6 to 12 months. And the name of the game here is to get a rate hold in place now, whether that's a pre-approval if you're looking to purchase or an actual application to switch to a different lender with a 120-day rate hold right now if you're coming up for renewal. The best time to do it is early because if rates continue to go up, even if you're 6 to 12 months away from buying, well, if they go up substantially and you've got a rate hold in place, you may decide to move up your timeline and save a ton of money as a result. And by the way, the people who did this in March, when we talked about this in some of our videos, are now moving up their timelines to make sure that they can purchase before the end of July to take advantage of those 1% lower rates. So this strategy works, it works in the past, and the important thing is to be prepared and to be prepared in advance. Oh, and if you want to know more about what's going on in the mortgage and the real estate market, make sure you check out one of these videos here.